The internal revenue shuffle. Intel is 5 days out from its Q2 2026 earnings call, and the Foundry revenue numbers are about to look better than they actually are. While the headline will likely highlight growth in the Foundry segment, look at the external versus internal split. In the last quarter, over 96% of Intel Foundry revenue came from Intel itself. This isn't a thriving contract manufacturing business yet. It's an accounting exercise where the design team pays the manufacturing team to keep the lights on in Arizona. By shifting costs between divisions, Intel can manufacture its own Nova Lake tiles and call it growth. But until the external line item crosses the $1 billion mark, it's just a circular economy. This internal volume is the only thing keeping their fab utilization high enough to prevent a total margin collapse before the real customers arrive. The 85% yield myth. Reports circulated this week claiming Intel 18A yields have hit 85%, but the profit and loss statement tells a different story. If yields were truly that high, the Foundry division wouldn't be sitting on a $2.4 billion quarterly operating loss. High yields on a test chip in Oregon are not the same as high yields on a complex AI accelerator for a customer like Microsoft. The reality is that Intel is currently the first to use ASML's high NA-EUV machines, which are engineering marvels but massive operational liabilities during a ramp. Every wafer run through those machines right now is a learning expense, not a profit driver. Think of it like a Ferrari that can hit 200 miles per hour but spends 6 days a week in the mechanic's shop. The technical milestone is there, but the economic math hasn't caught up to the marketing. This yield gap is precisely why the stock gave back 20% of its yearly gains earlier this month. The geopolitical insurance policy. Big Tech isn't signing with Intel Foundry because they think 18A is better than TSMC's 2-nanometer node. They're signing because the U.S. government is now a 10% equity holder in Intel. For companies like Microsoft, NVIDIA, and even Apple, Intel has become a necessary geopolitical insurance policy. The move to shift Nova Lake production back in-house from TSMC was less about tech leadership and more about securing domestic capacity in an era of trade volatility. These aren't performance-driven design wins, they're supply chain hedge bets. These customers are paying a premium for geographic diversity, and Intel is effectively a subsidized fortress for Western silicon. The real test isn't whether they can sign a deal with OpenAI, but whether they can deliver those chips without the government's hand on the scale. The signal under the noise. The hard truth is that Intel is currently a two-tier company, a product business that is slowly recovering, and a foundry business that is essentially a high-cost public utility. The strategic pivot to 18A was never about beating TSMC on volume. It was about creating a viable secondary source for the world's most critical chips. When you look past the 18A marketing, the real indicator of health is the gross margin gap between Intel's products and its foundry services. If that gap doesn't narrow significantly by the end of 2026, the external revenue is just a trophy, not a business model. For operators and investors, the move isn't to watch the yield rumors, but to watch the utilization rates at Fab 52 in Phoenix. That is where the cost of being the world's backup fab meets the reality of public market expectations. Watch the July 23rd earnings release, specifically for the Foundry's external backlog growth. If it's not expanding faster than the internal transfers, the redemption story is still just a subsidized experiment. Subscribe for more.